Sometimes a company issues stock to purchase the issued shares back into the corporation. When the company does this, they can either hold the stock for future use, which we end up calling that treasury stock or stock held in treasury, or they can retire the issues. And when they actually retire those shares of stock, they become unissued shares completely, as if they were never issued to begin with. So that is two possibilities. Why would a company want to purchase stock for treasury? Now that's the primary thing we're going to look at in this video is actually treasury stock. We've purchased it back in and we're holding it. Well, one reason would be a stock bonus. They want to actually give a bonus to their employees. Remember, stock has preemptive rights, so if we want to issue new shares, we first have to offer it to the current holder so that their stock value maintains the same percentage of ownership. So if you own 51%, if they're going to issue more shares of stock, then they're going to have to ask you first, basically. It's called preemptive rights before they can do additional shares. So if they want to give a stock bonus to their employee, what they'll end up doing is going out in the market and buying shares of those who wants rid of their shares of stock, and then they can distribute those shares to the employees without diluting our ownership. The next thing is a signal in the market. It may be that the company feels their stock price is too low in the current market, so they will buy that to maybe influence the market to pick up the pace, start buying the stock. And as we know, when demand changes or if demand goes up and the supply is limited, prices go up. So it could be a way to signal to the market that we think we're undervalued at that point. Another way is the acquisition of another company. We may want to acquire treasury stock as part of acquiring another company. Have those shares on hand to give when we merge or whatever. And then last is to alter our earnings per share or increase our earnings per share. When we limit the number of stocks that are outstanding, then our earnings divided over fewer shares actually makes it a larger earnings per share outstanding. So for example, if you make $1,000 and you have 1,000 shares out there, then that's $1 per share. But if you buy 50% of those back, so you have $1,000 in earnings but only 500 shares, well then that's $2 per share. So by limiting the number of shares outstanding, we can alter our earnings per share. We can make it higher. All right. Typically, a company will account for treasury stock using the cost method, or that's the method we're going to look at. And in the cost method, we simply record all the shares that we buy back at their cost, what we're actually paying. And then when we physically sell those shares out, we actually will reduce our treasury stock by the actual amount that we're selling out at cost. So think of it this way. Treasury stock is a contra stockholders equity account. It reduces our stockholders equity. So when we buy it in, we're going to buy it in at its original or whatever its cost is. It doesn't matter if it has a par. We're just going to simply pay the current market. And then we're going to turn around and we will sell that back out. And whatever price we receive for it, when we remove the stock from Treasury, the Treasury account, we actually have to remove it at cost. So let's look at an example here. On March 1st, Parker Company acquired 5,000 shares of its own stock at a price of $20 per share. Well, how would we record that? Well, first, what's going on here? We are acquiring, so we're buying, so we know we're having to spend money, so our cash is going to go down. And to take cash down, of course, we need to credit that account. Well, what are we going to debit? Well, in this case, we're buying stock, our own stock, and we're holding it for Treasury. So we're actually going to debit our Treasury stock account. Now, we got to look at it and see how much are we hitting our Treasury stock account for. Well, in this case, you have to notice we're buying 5,000 shares of our stock, and we're paying $20 per share for those. So that comes out to $100,000. So that's the amount we're paying. And again, we've already said how are we buying that treasury stock. It is actually cash. Now keep in mind, a lot of people want to say, well, treasury stock's an investment. It is not an investment. We cannot record gains or losses, so to speak, on treasury stock. It is a contra stockholders equity. It will go in as a debit, so it's a contra stockholders. It's going to reduce the overall stockholders equity of our company. Okay, so in this transaction, cash is going down, but so is our equity, our stockholders' equity section of our accounting equation. Okay, now the next thing we've got is on April 5th, Parker Company sells 1,000 of the shares purchased on March 1st for $25. All right, so we bought those on March 1st. We paid $20. Now we're turning around. We're selling them on April 5th for $25. So what would we record? Well, when we sell those out, notice we are receiving cash, so we need to take into account that we're receiving cash. And how much cash are we going to receive here? Well, again, we're going to take those 1,000 shares that we have that we're selling, and we're going to multiply it by the price of $25. So that's going to come out and give us a $25,000 increase in cash. Might help if we get in the right box there. There we go. All right, now what else is going on? Well, we are selling out Treasury stock. So what has to happen to our Treasury stock? It needs to go down. And again, how much are we going to take our Treasury down by? Well, remember, Treasury stock has to be carried at cost. So we put it in at 20. So when we back it out, we have to also back it out at $20. Okay, so we're going to hit that for 20,000. That's 1,000 shares at $20 per share. Now notice how we have a $5,000 difference because we actually sold the stock for more than we paid. Well, where do we get that? Well, different books call it different things, but I'm going to call it paid in capital from Treasury. Now, it could be additional paid in capital, shares repurchased, that's a possibility, but I'm going with paid in capital from Treasury. Again, it could be different depending on the company. All right. So on May 15th, Parker Company sells 1,000 of the shares purchased on March 1st for $32 per share. So how would we actually treat this transaction? Well, we're going to look at this and we'll say, okay, one, we sold 1,000 shares at $32 per share. So that means we're receiving cash. So our cash is going to go up for $32,000. Now again, when we look at it, remember we have to remove the Treasury stock. We're selling out the Treasury stock. So we've got to get rid of the Treasury stock that we're actually selling out. And when we look at this, we're selling out Treasury stock, 1,000 shares. And remember, how much did we pay for that? We always handle the Treasury stock account at its cost. We paid $20. So we're going to hit it for $20,000, which is 1,000 shares times the $20 per share. Now notice, again, we received more for our stock than we paid, so the additional amount goes into what we call paid in capital from Treasury. Anytime we have more, we receive more than we paid, we actually put that in our additional paid in capital account. And we call that paid in capital from Treasury, or sometimes you may see it termed additional paid in capital, shares repurchased. There's different accounts that could be called, but they all mean the same thing. It's the amount of money we received in excess of the cost of the stock. All right, so now let's look at this last transaction. And in this case, it's going to be a little bit different. So on December 12th, Parker Company sells 3,000 shares of the shares purchased on March 1st. So now we're selling off the last little bit of Treasury shares we had, and something happened to our stock price. I don't know what happened, but it went down to $14 per share. I know. It's a drastic change, but I'm doing this to prove a point and just so you can see what would happen if we did sell it for less than we paid. So we've got these 3,000 shares, and we purchased on March 1st. Remember, on March 1st, we paid $20 per share for those. So now, when we're looking at them, we have to take them off. So again, we're receiving cash. So we need to hit our cash account. Well, in this case, how much cash are we actually receiving? All right, so we have the 3,000 shares at $14 per share again. And when we multiply that out, it's going to come out to 42,000 in cash. That's the amount of cash we received. Now, in this case, remember, we paid $20 per share. So when we take this off, we know that we are actually going to have a little bit of an issue here. So let's credit the Treasury stock for the amount that we have. And again, what did we say? We said it is $20 per share at 3,000 shares. So that would be 60,000 that we would pull off. Now notice how much different that is. That is a difference of 42.52, $18,000 there. So what are we going to do with the 18,000? Well, our first initial reaction is, well, just take it out of paid in capital. If we have an excess, we put it in. So if we have less than our selling price is less than our cost, then we might as well take it out of that account. And that is true, but we have to be careful. Paid in capital accounts cannot have a debit balance. So we can debit the account, but we can only debit it for as much as is sitting in the account. So how much do we have in the account? Well, when we look at it, notice we put in 5,000. And then later on we put in 12,000. So we only have $17,000 sitting in that paid in capital account. If that is the balance, that is the most we can pull from it. So now keep in mind, we need 18,000. We only have 17 that we can pull from the paid-in capital. If that happens, by default, we have to reduce the cumulative earnings of the company. So we actually have to go in and reduce retained earnings. We're not allowed to record a gain or a loss on sale of treasury stock. It's not allowed. It's our own stock, so that would sort of be odd if we could buy and sell, alter the prices somewhat by buying and selling, and then sell it for a gain or loss and put that on our income statement. We cannot do that. So it has to come out of just our cumulative retained earnings, so it does not impact our actual financials. Well, excuse me. It impacts the balance sheet, but it doesn't actually impact our income statement. Let me rephrase that. All right. So in this case, if you do sell the Treasury stock for less than you paid, the first thing you have to do is check the paid-in capital from Treasury. Do I have enough sitting in the paid-in capital account to pull for this transaction? And the answer here is no, we don't quite enough to cover it. The difference there is 18,000. We only have 17,000 sitting in the paid-in capital account. So in that case, we know that we don't have enough. But we're going to go ahead and pull everything we possibly can from the paid-in capital. We're going to zero that out first before we default and go into retained earnings. Again, if we do sell it less, we do not have enough in paid-in capital. It does reduce the retained earnings of the company.